Few sectors have been as rewarding as technology in the past couple of years, or as volatile as technology in the past couple of weeks. From seismic shifts in the political and regulatory environment to the deep sixing of virtually any stock related to AI, tech investors have had plenty to ponder in 2025. To provide some guidance about what's going on, and more importantly, what to do about it with your tech portfolio, I've invited one of the sector's leading experts to join me here on the Money Show MoneyMasters Podcast. He's Mark Mahaney, Senior Managing Director and Head of Internet Research at Evercore ISI. Mark, I'm really glad you could join me here for this discussion. There's just so much to talk about in the tech sector these days. But I really want to start with this big AI shakeup that we had with kind of this DeepSeek news. How important is that for the sector that you follow? And how do you see things shaking out from here?
Well, the single biggest technology trend right now is Gen AI, and so to the extent that somebody stands on somebody else's shoulders and comes up with a great efficiency hack, I don't mean that in a negative way. I mean that in a really positive way. Figures out a way to run AI models at a much lower cost, much lower compute cost. That's has significant implications across the industry, and so now what's come out since all the news about DeepSeek is maybe a few questions, more questions about the quality of the model and about this security and stability of the model. But I think some of the hacks, I mean, that's what they are. Yeah, I mean that in a positive Silicon Valley engineering sense. Like hacks are a good thing. Some of the improvements, the efficiency gains, the hacks that and it's all open source, so that they have documented. I think other companies you'll see utilize those to run their models more efficiently, to build and to run their models more efficiently, and that's good for these companies that are buyers or deployers of models.
And that's really what it gets down to, right? I mean, is this going to create different kind of winners or losers in the sector potentially than maybe what we would have thought a couple months ago before anybody really heard of this?
I don't know, Mike. My guess is at the end of the day, it won't, because maybe for two reasons. Either it is going to just bring down the cost of large language models. It'll help bring down the cost. Like it's never one company, one innovation that does it. Just these innovations feed on each other. There are companies standing on the shoulders of other companies and doing this. Just like ChatGPT and OpenAI really kind of moved the needle, had a great innovation hack. This is a great efficiency hack. And then other people can take advantage of those and build on top of them. And so I'm not sure it really changes the list. There's a couple of, I think, kind of relatively clear winners in this, at least the space that I look at, which is Meta. I think is one that doesn't sell, is not a vendor of large language models, but uses them and has used them very effectively to improve their product for both consumers and for advertisers. So if you're going to make one of their biggest cost items the cost of managing a large language model, like they're out there spending 60 to 65 billion on capital expenditures, capex this year. That's a lot of money. A good amount of that is geared towards having the network infrastructure, the devices, the servers to run these models. You can figure out a way to run these at a lower cost or to run at the same cost. Either one of these is a win for a name like for Meta. I think it's also a win for names like Google and Amazon, but it's not as emphatic as it is for Meta.
Okay. All right. I want to talk. And since last time I had you on the show, obviously, probably one of the biggest changes has been in the political space. I mean, a new administration, new regulatory approach, the whole nine yards when it comes to the technology sector. And of course, also tariffs. Can you talk a little bit? Again, we don't have to get political, but just kind of what the impact is of the new policy approach and things like tariffs, if any, on the tech sector right now?
Well, it's a major change. So maybe I'll try to divide this in three different topics. One is, regulation. There's no question that big tech has been much more aggressively scrutinized over the last couple of years for a variety of reasons, whether that's right or wrong. It just has been. And you also had, under the Biden administration, a very aggressive, maybe a generational change approach in the towards antitrust regulations. They were much more aggressive about stopping mergers, challenging mergers. And again, right or wrong, I'm not a lawyer, but they were much more aggressive. It's kind of hard to see how the antitrust environment doesn't get more accommodating, less aggressive under President Trump. I think that's pretty clear. And so the companies that were most aggressively targeted that there's a little bit of a relief rally. And just to be very specific about it, one stock that I like is Google. I think the chances of a settlement between the U.S. government, the Department of Justice, and Google have increased since the election of Trump. I think that's true. Whether it actually happens or not, I don't know. But the odds have definitely increased. So that's one level. And then tariffs. Okay, it's hard for me to see how any of these companies benefits from tariffs. These are the most of the large tech companies are large because they have global multinational operations. Some of them are directly importing products. That would be Amazon, and China is a pretty significant. It's pretty significantly high on that import list. But all these companies have got exposure to companies. So now, if I'm talking about either because they're cloud services, sell services to companies that are involved in a lot of cross-border trade, for different components of what they're creating, or I mean, just go up and down the list. Food and beverage companies. I mean, so anything that kind of snarls, creates inefficiencies, creates more roadblocks towards international trade is going to be a negative drag on the economy and a negative drag on these companies, particularly since they have a lot of they're so large and they have a lot of cross-border exposure. So, yeah, I think that's an easy call there. It's just negative for rising tariffs, and then the third thing is maybe a more pro-growth agenda. And yeah, it's interesting to me. I think if you think about Silicon Valley, which typically I think there's been a change in Silicon Valley and the politics of Silicon Valley, which has generally been, more democratic leaning. And, it's interesting, just a lot of the tech company leaders really kind of went out of their way I think there was a generational challenge, maybe a little bit with the Biden administration, kind of funny both ways, but you had a president who was probably less enthusiastic about technology companies than most presidents, maybe in the last, 20 or 30 years. And even though there's some sideline tuffles in terms of President Trump and some of the leaders of tech, I think generally this administration seems to be much more willing to embrace large, successful American technology companies. I think that's true, and they are certainly trying to position themselves that way too. So, the extent that you've got more pro-growth strategies, reduction in regulations, that should be beneficial for tech. So I think about three different topics, regulation, tariffs. I'm sorry, I meant antitrust, tariffs, and then overall regulation. And there's some wins in there for tech, and there's some losses in there for tech. I think at the end of the day, though, as most people who are stock pickers like myself, most of the stock action comes either from overall macro trends, and then but that's part of it. But the bigger factor is always the company's own fundamentals, and Meta, Google, Amazon, Netflix, Spotify, Uber. I mean, they're going to, at the end of the day, trade based on whether their fundamentals are strengthening or whether they're deteriorating.
Okay. And speaking of that, we've obviously gotten some of the big tech earnings already out this season. I'm curious, any big one or two trends that stand out to you in the numbers so far?
No, I want to be very careful about that. I don't think there are any trends. You've had two major companies that I track, but there are a whole bunch coming this week. Two major companies that I track, Netflix and Meta. And sometimes you got to know when they're idiosyncratic and when versus whether they're a broad industry read. So I gave you a more emphatic answer than I really meant, Mike. I think Netflix is idiosyncratic. Netflix is running away with the streaming market. Netflix have got an extremely powerful content slate. People refer to product cycles with companies in tech. Netflix is a content cycle company, and they're just bringing out the hits, and the Hollywood strikes are behind them. So they can just, the content slate is just going to be more, it's going to be better, and it's going to be more consistent than it was the last 2 years. There's not going to be any gaps in there. And the rest of the industry, I'm exaggerating here, is sort of folding, is not spending as much. And what it means is that the value proposition to consumers from a Netflix subscription is just getting stronger and stronger. They even raised the prices, but $7.99 for all of that, for access to 18 billion of content on Netflix. It's one of the best value propositions that a consumer can face right now. So, but I think that's really kind of idiosyncratic to Netflix. Meta may be a little bit more of a product read, a market read, but they're in the middle of a very strong product cycle. A lot of that's generated because of AI. all the marketers I talk with, the advertisers I talk with, will tell you that it's the performance of their campaigns on Meta has materially improved over the last 2 years. That's a product cycle. Now, it also happens that most marketers, most advertisers are just more confident now than they were a year ago, 2 years ago. We had a lot of recession fears for right or for wrong reasons, but we had them. Turns out they didn't really come through. Turns out we didn't have a soft landing. Actually, we may not have even landed. If that may be the macro truth. And so that means marketers, advertisers are much more willing to step in and spend now than they were at the beginning of 2024. So that is in ways a little bit of a positive read-through to other advertising names. But I don't want us to ignore the fact that we got a major product cycle going on at Meta. If you have a major product cycle going on and you have exposure to the markets like Meta has, your fundamentals would be as good, but very few companies look like that.
Got it. Got it. Okay. It was interesting. I went back recently and looked at some of the names you've mentioned at previous Money Show events, and you were in the Silicon Valley event last May, and all four of the stocks did very well. A couple of them 44, 65% gains recently. Do you still like those names were DoorDash and Expedia? I'm kind of wondering, sort of an update on what you liked before. Has what you liked the most radically changed, or is it still kind of in the same venue as or universe of what you were looking at a year ago?
No, I made some changes along the way. And Mike, we should, there are times. I the thrust of my learning in my career has been to hunt for these DHQs, dislocated high quality companies. And we're in the 2.5 years into a pretty big bull market for large cap technology companies. It's a very powerful bull market. And I think it continues for a while. But I have I'm not no disillusions here. There are very few dislocated great opportunities to really step in and buy and hold. Look, I buy aggressively. That's why I'm not hold, but in hold. I like Netflix here, but it's not a big buy. It's a small buy for me. Same thing with Meta. I mean, there's just some valuation limits here. Even with fundamentals getting better, I think that's really what takes the stock up. The valuations, you're not going to get a 50% move in the stock. Now, people just checked that about Netflix 50% ago, and they surprised me. But still, you got to have some valuation discipline. And I'm much more willing to look at fundamentals than most people in terms of the fundamentals versus valuation. There's only really one truly dislocated name at tech that I look at, and that's Uber. And it's dislocated and it's controversial for a very good reason. They're considered to be robo-taxi roadkill. And that fair concern may well be right. We're going to find out. May well be right. I'm taking the other side of this. So I'm taking the risky, I got a contrarian position. A lot of people are looking to sell a short Uber because they think Waymo and Tesla are going to undermine, obviate the need for ride-sharing networks. I don't think that's going to happen. And so is depending on which way the narrative goes. Right now, the narrative is going, bearish on Uber. I think that narrative can turn. I think there's a few events that could cause that to turn. And I think the valuation here, again, I don't lead with it. I lead with fundamentals. I think their growth rate can stay very consistent. It's not going to crack because of robotaxis anytime soon. I think their profitability is going to continue to ramp. Free cash flow generation is going to continue to ramp. And this stock is sitting, like 15 times cash flow for cash flow growth. That's like over 30%. It's rare you see that kind of difference. Normally the multiples come close to the growth rates. Here I have a case where the multiples are about half of the growth rate, which means the market believes this growth rate is going to come crashing down soon. Which means if I take the other side, all I have to do is assume that, not all I have to do, but like one of the things I have to do is assume that the growth rate can kind of hold, stay constant. Because if it can, then that multiple's got a lot of re-rating ahead of it. So I'm sticking my neck out on Uber. It's my favorite pick. I'd say 6 months ago, the really dislocated stock that was our top pick back then was Amazon. I like Expedia because it's really dislocated. And so when Amazon and Expedia have had their big runs like they have, I could still remain a buyer. I'll be patient about it. But no, they're not aggressive buying points here. So I've shuffled my list a little bit. And, I'm one of those who I wouldn't mind a market correction because I think I'd love to buy some of these high quality assets at cheaper prices. I have no particular view what causes that. Maybe a trade war does. There's always those black swan events out there. The unknown unknowns.
Yeah, absolutely. Well, listen, Mark, I appreciate you taking some time out here, share some of your insights in this session, and an abbreviated version of what you're going to get when you get to see Mark at the Las Vegas Money Show Traders Expo that we have coming up. It's February 17th to 19th at the Paris. He's going to be going into details, talk about some of his favorite ideas. and stocks out there, and you're going to learn a lot and have plenty of time for Q&A as well. So, Mark, thanks again for your time, and we'll see you in Vegas soon.
Take care, Mike.